$14 billion, that was the size of the empire at its peak. It was run by a man the world called a visionary, a capitalist with a conscience. His flagship fund had a beautiful promise. It would build hospitals for the poor across Africa and Asia. The money came from the best names on earth, the Bill and Melinda Gates Foundation, the World Bank. It was called impact investing, doing good and doing well at the same time. Then investors went looking for the hospital money. And a large part of it was not there. This is the story of Abraaj, once the biggest private equity firm in the developing world, and of Arif Naqvi, the man who built it from $3 million and lost it in under a year. It became the largest collapse of a private equity firm in history. Prosecutors say hundreds of millions meant for the poor were quietly used to plug the holes in his own machine. Here is how. Arif Naqvi grew up in Karachi, Pakistan, a sharp, ambitious boy with a gift for winning people over. He was charming, brilliant, and hungry for a bigger stage than the one he was born on. He made his way to Dubai, a city being built into a monument to money and ambition. In 2002, with just $3 million, he founded a private equity firm and named it Abraaj. Private equity is simple to describe. You raise money from big investors. Buy companies, improve them, and sell them for more. But Naqvi added a story that no one else was telling as well as he did. He would invest in the places others feared: Africa, South Asia, the Middle East, the emerging world, and he would make money while lifting those places up, profit and purpose in the same deal. He called it impact investing, and he became its most famous preacher. On the stages of Davos, before the most powerful people alive, Arif Naqvi sold that dream. The dream sold, money poured into Abraaj from around the world. Sovereign wealth funds, pension funds, banks, billionaires all wanted in. At its peak, Abraaj managed almost $14 billion across more than 40 funds. It became the largest private equity investor in the entire developing world. Naqvi joined the Giving Pledge, the club of billionaires who promised to give their fortunes away. He came to know Bill Gates personally. The boy from Karachi now moved among the richest people on earth. He was not just rich, he was admired. He was proof that capitalism could have a heart. Awards, magazine covers, standing ovations. The halo around him grew brighter every year. And the brighter the halo, the less anyone wanted to look underneath it. Underneath it, the most important fund of all was about to be born. In 2015, Abraaj launched its crown jewel, the Growth Markets Health Fund. Its mission was pure. Nearly $1 billion to build and upgrade hospitals and clinics for the poor. Places where a simple clinic could mean the difference between life and death for a whole town. The investors were not ordinary. They were the conscience of global finance. The Bill and Melinda Gates Foundation put in around $100 million. The World Bank's investment arm came in, so did Britain's Development Finance Institution. These were people who measured success in lives saved, not just returns earned. They trusted Naqvi because his whole brand was trust. He spoke their language of doing good. The money was handed over, ready to become hospital beds, operating rooms, and clinics. But between the promise and the buildings, the money had to sit somewhere, and that is where it went wrong. Building hospitals takes time, deals are slow, so the fund's money did not get spent all at once. Hundreds of millions sat in the fund, waiting to be deployed into real projects. To an honest manager, that waiting money is untouchable. It belongs to the investors, held in trust. But Abraaj had a problem the world could not see. It was often short of cash itself. Its own running costs, its own debts, its own commitments kept outrunning its real income. So, prosecutors allege Abraaj reached into the money that was meant for hospitals, not to build anything, to cover its own shortfalls, its own holes, its own bills. Investor money and company money, which must always stay separate, were quietly mixed together. In finance, that mixing has a cold, technical name: commingling. And once you start, the only way to hide it is to keep doing it faster and faster. There was a trick to keeping it hidden, and it was almost elegant. Investors and auditors check the accounts on certain dates. They want to see the money is really there. So around those dates, Abraaj would pull cash in, borrow, shuffle, and make the balances look full. The books would show healthy funds right on cue. Then once the check was over, the money moved out again. Borrow to look solvent on the day of the photograph. Return it in the dark. Repeat. Liquidators would later allege this pattern ran through more than 3,700 transactions, and that it had been going on quietly since at least 2014. This borrowing against the appearance of health is the thread that detonates everything. Remember it, because a machine like that has one fatal weakness: it must never, ever be looked at too closely. And in early 2018, the people who paid for hospitals decided to look. Some of the health fund's money had been sitting undeployed for a suspiciously long time. The investors, led by the Gates Foundation and the World Bank's arm, wanted a simple answer. Where is it? It was a reasonable question. It should have had a simple answer. It did not. They hired forensic accountants to trace the money dollar by dollar. Abraaj pushed back. It commissioned its own review from a major accounting firm to calm everyone down. in February. That review reported that it had found no misuse of the money. For a moment, the storm seemed to pass. Naqvi could point to a clean report and say, "You see." The powerful investors were asked to trust the paperwork and move on. But the numbers still did not add up for the people who had put the money in. They did not move on. They decided to bring in someone else to look, and that changed everything. On the surface, Naqvi still looked untouchable. A clean review, a restructuring he called planned. He announced he would step back from the fund business but stay on top of the empire, all under control. To the outside world, it read like a proud man tidying up a misunderstanding. Too respected to be a crook, too celebrated to fall. The Davos applause was still echoing. Then the investors brought in a second accounting firm and told it to open every drawer, this time. There was no reassuring headline. The examiners followed the money out of the fund. They traced it away from hospitals and into the veins of Abraaj itself. The whole was not a rounding error. It was hundreds of millions of dollars over years. The clean report from before now looked less like comfort and more like a curtain. Once the real numbers were seen, they could not be unseen. The empire began to fall. Confidence is the only thing holding a firm like this together, and it was gone. Abraaj was in the middle of raising a giant new fund, as much as $8 billion. Now investors demanded their commitments back. Around $3 billion was returned. The message was brutal and clear. No one trusted Arif Naqvi with their money anymore. Creditors who had lent to Abraaj began to circle, wanting to be paid before the walls came down. A pension fund from Kuwait moved against it. An airline that had lent it money wanted its cash back. The company that once managed $14 billion could not cover its own debts. In June 2018, Abraaj filed for liquidation in the Cayman Islands. From the applause of Davos in January to the brink of collapse, it took under 10 months. The largest private equity firm in the developing world was being taken apart, fund by fund. When a private equity firm dies, it does not die alone. It holds other things in its hands. Abraaj held more than 40 funds with companies in health, energy, and lending across 4 continents. All of them were suddenly orphaned, their futures hanging on liquidators and rival firms. 350 employees watched a company they believed in dissolve around them. But the sharpest wound was the simplest one. The fund that was supposed to build hospitals for the poor. The money that families in Africa and Asia would never know had been meant for their clinics. Most of it, prosecutors say, did not go to yachts or mansions. It went to feed the machine, to keep the empire looking healthy for one more reporting date again and again. The conscience of global finance had trusted a story. The story had quietly spent their money, and still the question stood above all the wreckage: how was this hidden for so long? The answer would now be argued in courtrooms on 2 continents. In the United States, prosecutors charged Naqvi and other executives with fraud and racketeering. In April 2019, Arif Naqvi was arrested at an airport in London. He was held in a British prison, then freed on a record bail of £50 million. It was reported as the largest bail ever set by a British court. He was placed under house arrest. One of his top partners, arrested in New York, pleaded guilty in open court. He said he had known at the time that what he was doing was wrong and that he was ashamed. Dubai's own regulator fined Abraaj around $300 million and later fined Naqvi personally. That personal fine, over $100 million, was the largest it had ever imposed on an individual. And the giving pledge, the billionaire's promise to give it all away, quietly removed his name. There is one part of this story that did not end in ruin. Another firm stepped in and rescued the health fund. The hospital money was eventually returned with interest. The clinics that were promised largely survived under new hands. The poor did not pay the final bill, but the reckoning for Naqvi is still not over. Years later, he is still fighting extradition to the United States. Liquidators now allege he took $385 million over nearly a decade. Arif Naqvi denies all of it. He says it was a conspiracy against him, a liquidity crisis, not a fraud. He has not been convicted. In law, the case against him is still an allegation, still being tested. So what was Abraaj really? A visionary undone by cash flow and enemies, or the most admired man in ethical finance, running a hidden hole under a halo for years? The regulators find him. One partner confessed. The extradition fight goes on, so you tell us, what was it?